Hey, this is Yang Nguyen, and you're listening to the Immi-Wealth Builder podcast, where we celebrate incredible immigrant success stories, share proven strategies, and give you actionable steps to build your wealth, freedom, and a lasting legacy. Let's go get it. Too many professionals delay investing and missing years of freedom and wealth building potential because they think that they need to just do one thing at a time or quit before they move on to investing. I really love this episode because he's going to share with you how to go from a full-time employee to building wealth in real estate and also becoming a business owner. Jay, welcome. Thank you so much for being here. I would love to have you start by just introduce yourself, where you're from, kind of your background before you start investing.
Absolutely, Jiang. And thank you so much for having me. It's a pleasure. We've had some really awesome conversations offline, so I'm super excited about this. My name is Balekar. I'm based in Cincinnati, Ohio. Originally, I grew up in India until I was 18 years old. And then I moved to Texas for my undergrad. And then I moved to Cincinnati for my grad school. So that's how I ended up in Cincinnati. Right after grad school, I got a job in cybersecurity consulting. With consulting being client-focused, it was a travel job, so I was mostly traveling, mostly to East Coast. So ended up staying in Cincinnati. My wife, who was my fiance back then, ended up moving here as well. And we just like the Midwestern vibe. Things are a lot more affordable here. And now Cincinnati is home. So I've been in Cincinnati since 2011, so almost 15 years. And this is kind of where I started my real estate journey as well. So it sounds like we're going to be here for a while.
That's awesome. Tell us a bit more about kind of your mindset around money, around investing growing up, and maybe when did that shift as you spend your life here in the US?
Absolutely. I think that's a fantastic question. And I think even looking back at my journey, I've always tried to think about why do we think the way we think? Why do our cultures have certain beliefs? And once you understand what each country or culture has gone through, it helps you understand why our parents think the way they think, right? And I think our kids are one day going to think about the same way, that why did our parents think the way they thought about it? So I think in India, there definitely is an extremely firm belief in getting a really good education. That's how I grew up. My dad's an engineer as well. But I think where that belief comes from is, after about 200 years of being colonized by the British, all of the wealth that we had in the country was basically taken away. And then after India got independent, your only chance of having a relatively comfortable life and some level of financial security was by getting a good education. And if you, let's say, became a doctor or an engineer or maybe an accountant, you will get a good job that pays you decent money where you can actually afford to buy a decent home and raise a good family, right? And have a good family life. That was really the only path. Entrepreneurship in India now is getting easier, but back then, because it's a developing country, the corruption levels are high, it is extremely difficult to be an entrepreneur because of the corruption in the society, but also capital is hard to come by, right? It's not a country where capital was very easily available. Again, things are changing now and capital is moving to those markets too. And now we see more and more people get into entrepreneurship. But because of that background, that's why there is a very firm belief in focusing on a strong education. And I still feel like it is very important because if you have a strong educational background, it can always come in handy. It doesn't go to waste. If God forbid something happens and you have to enter the job market again, you have skills and you have the credentials to be employable again. So you always have that as a backup option. And a lot of the skills that you learn in school and college do very much come in handy, even if you're self-employed or if you're an entrepreneur.
I really want to emphasize what you share there about this transferable skills, right? Your background as engineer, that comes with different type of knowledge, but very important skills that I'm sure you took with you as you transitioned over into a full-time real estate investor and business owner. I want to go back into the moment where you decide to start investing. Like what prompted that? How did that start?
So just kind of going back to my journey where I just graduated from school, got a full-time job. My wife got a job about the same time. And, as students, we were extremely frugal, living off of like $300 to $500 a month, really, with 4 other roommates. And suddenly having a job where you definitely have more than what you need, the initial reaction is you just start spending money. You buy nice cars, you end up buying a house, you start taking some vacations, and you're just having fun, enjoying your life. And the stress levels are also low because you're still kind of new in your career. So you're not yet climbing the corporate ladder. So it's the best time of life. I do think that you should enjoy a little bit of the money that you are finally earning. But after you go through those first couple of years, you start to realize that now you really have everything that you wanted in terms of stuff that you wanted, right? The material things. And now it's like, okay, anything else that you buy is not really leading to more happiness. And now you have some money left over. Saving money was always enforced into me by my parents that you have to save money. Anything can happen any day, a rainy day fund. It was more like 70% needs to be rainy day fund and you live off of 30%. So we were saving up quite a bit of money. And the first thing that we were doing is pay off our cars. And in the first 5 years or so, we paid off our home loan. And at the time, all of that was like in the mid 2% interest rate. So looking back, I feel like that was a pretty stupid idea. I should have used that money to make more money than pay off a 2.5% loan. But you know what you know. So essentially, as your pay scale goes up, but your expenses are not going up. And we were never about keeping up with the Jones. So even if the pay was going up, we were not like really buying fancy cars or fancy home and stuff like that. So we started thinking about, okay, we have all of these savings. What can we do so we are investing these savings wisely? Of course, stock market was always an option, or fixed deposits or bonds, which provide pretty minimal returns. Then I started looking into real estate because my dad has been a real estate investor back in India. It's not like a big time real estate investor, but he owns just a handful of apartments that he paid off while he was working. And that has now become his retirement plan because he didn't have a government job, so he doesn't have a pension. But the rent he collects from his 4 to 5 apartments gives him more than a comfortable life in his retirement, right? So I kind of saw that and I was like, if it can work in India, it has to work in the US, where capital is easier to come by, loans are easier to get, interest rates are lower. So that's what got me into it. And then I started reading a lot of Bigger Pockets books, Ken McElroy books, Joe Fairless, everything that I could get my hands on. So before I really started investing, I spent about 1.5 to 2 years to almost read every single real estate book and also some business books to get a sense of flipping, single family home investing, buy and hold, wholesaling, multifamily. And when I compared kind of all of those options, I felt like multifamily had a really good case study where I could actually grow faster and the cash flow looked better. And that's why I kind of started investing in real estate. And my first investment property was multifamily. So I never really did single family investing, but that was like late 2019, right before COVID. And just kept on going from then.
Wow. You brought up so many great questions that I really want the audience to understand. The first one was about this balance of life. I love that you shared, yes, you were frugal, but you really shared that important piece about like, it's not so much about just living unhappily in life, right? I think there's moments things that you can save, but there is also moments where you should be enjoying the fruit of your labor, like how hard you work to get a degree, to get a good job. So I really love you share that, first of all. The second thing that I really want to point the audience to is what you share about the cost of capital. And I think this is what I share a lot with investors is that no matter what kind of interest rate environment you're in, kind of your primary home mortgage will always be that lowest interest rate. And at that point, at 2 point something percent, it's very important to consider like, hey, can you use that money to go somewhere else that will pay you a higher return? So always think about what does it look like? And I know for a lot of the audience, debt might be that like bad word that we're not used to. But the same thing, like really the important concept here is the cost of capital, right? How much does it take for you to get that capital? And can you make the money work better elsewhere? So now that difference is actually free money for you to keep growing your wealth. So that second piece that you brought up, the cost of capital, is super important. The third piece, I love what you share about the education, right? I really love that you compare a lot of different assets, take your time to really get educated about all the options. And I like that you land on multifamily. So high level wise, right? The strategy, multifamily is a strategy. It's a very popular asset. It's one of the best risk adjusted return asset. Tell us about your favorite things about investing in multifamily and why you settle with that as your asset to grow.
Yeah, I mean, several benefits. And even now looking back, because multifamily was everyone's favorite child up until 2 years ago. Now, not so much, right? That's how it is with market cycles and asset classes. But even now, like we constantly look back and see that, hey, is multifamily a good asset class for us to be in today? And we've always come back to the same answer that it is, right? Sure, the margins have gotten thinner, but you mentioned the word risk adjusted. And that's really the key. It's not always the highest return that we are chasing, it's the highest risk adjusted return. And it was mainly for that reason why I chose multifamily, because first and foremost, you're housing people and you're providing a basic human need, right? So if you're in any other asset class, for example, industrial, retail, office, it's not really a basic human need. So you have to recognize that, sure, some of those asset classes might give you a better return, but it also comes with a slightly higher risk. Again, depends on what market cycle you're in and which markets you are in. The other thing was single family versus multifamily. The potential for cash flow was definitely better on multifamily because it's one roof over 8 units or 12 units rather than one roof over 1 unit. So your expenses get spread across multiple units. If you have one vacancy, two vacancies, you're still about 90% occupied. You have single family home, you're all vacant or all occupied. It's a little bit more operationally intensive when it comes to multifamily. So as you scale up your multifamily portfolio, you definitely got to have your operational ducks in a row, either have a really good third-party management relationship or do it yourself and build those systems. I would say that that's one of the challenges with multifamily. But multifamily on the commercial side is same thing like any other commercial property. It's all about the NOI growth. And as long as the cap rates stay stable or are compressing, you're adding significant value to your property. Banks are more than happy to lend on multifamily over long-term debt. So there are multiple different factors which definitely make up a really good case for multifamily. And that's how I ended up on it. And ever since, just fell in love with the whole process.
Amazing. I love it. I know you did your research, land on multifamily. Tell us about that growth that you had. And at what point did that make sense for you to consider leaving your W-2 to become a full-time real estate investor?
Yes, that's a great question because I think for a lot of people, that's kind of the initial struggle. That they start buying real estate, but it's not enough where they can quit the job, but it's adding more work to their workload. Now they have a stressful job and their real estate that's taking a lot of their time. I definitely went through those cycles, and there were a few years when it was just getting crazy. Late 2019, I bought my first 8 unit, and it was a heavy lift, full gut renovation. Right after that, in a few months, COVID happened, so my travel stopped. So I was actually pretty much completely managing that construction, and I was working from that job site out of my truck and taking all my Zoom
Wow.
calls from my vehicle. Because it was the first time for me. It was a $400,000 property that needed $250,000 rehab. So it was a big
Wow.
deal. And we had taken a
Mm-hmm.
HELOC to fund that rehab. So it was kind of crucial that everything had to go relatively right. Because otherwise, we are jeopardizing a house that we had fully paid off to pursue something that did not work out, which is fine. You learn from your mistakes. But through that process, I built good contractor relationships, learned a lot about renovations, got that project done in about 6 months and did a full cash out refi about a year in and pulled all of that capital out and just paid off my HELOC again. And I was like, wow, this thing actually works. So after the renovations were done, then we started managing the property ourselves. So we still manage that property ourselves between just me and my wife. And then after I did that property, after the full cash out refi, we did another one, 10 units. Then we did a 12 unit, then another 8 units. So we got to about 40 units in terms of our personal portfolio in about 3.5 years or so. And up until that point, I had not taken any investor capital because I wanted to go through multiple deals where I'm only risking my capital. And after I had done that for about across 5 deals, that's when I did my first joint venture deal, a 63 unit here in Cincinnati area, with some of my partners that actually I first met through Bigger Pockets. And we stayed in touch and we wrote offers on deals. Many of them didn't work out. And finally one stuck and, they flew out here. We closed the deal. And that was my first experience working on a larger property. Never in my wildest dreams, I thought that I would close on like almost a 70 unit in the first 3 years of my experience. And again, I think that's the whole difference, that once you start networking with the right people, your perspectives change, your limiting beliefs change, because things that almost might seem impossible initially, or you have these beliefs like people who already have money do these things. But that's not necessarily true. They somehow got there and took baby steps along the way as well. But once you start talking to the right people, you start to see those baby steps, which might seem almost impossible initially. And that was a big mindset shift for me, going from 8 units to 70 units. I was like, okay, now we have closed a 70 unit. So this is possible. So we can go and buy a few more of these as long as there is intrinsic value in the property you're buying and the numbers are strong and you have a track record of managing and creating a lot of equity in these. You will have partners and investors who would be ready to invest with you alongside you. So that's kind of how it started. And after that, we did multiple JV deals. And then in 2022, I believe we did our first syndication deal. And that syndication deal was also like a smallish deal, like 36 units. We could have easily done that as a JV. And some people even asked me questions. Why are you syndicating this? Why don't you just do a JV? And my answer was that we want to try the vehicle of syndications. And I might as well start small, where if we make mistakes, those mistakes are a lot less expensive. And we have already closed deals of that size instead of going and buying a 200 unit as the first syndication deal and losing people's money. So in retrospect, I think no exposure to bridge debt during these times when interest rates climbed up like crazy, sticking to smaller and mid-sized assets as we were learning, and also sticking to a smaller group of investors. It definitely helped us quite a bit in managing these properties well and keeping our stress levels a little bit under control as well.
I love the thought process so much. You have experienced exceptional growth and you get there by obviously working really hard, but you are very focused. You're in one market, you're in one asset. When you first growing your portfolio, they're all kind of similar size. And I'm guessing similar approach, kind of that value add to then refinance. So for the audience, if you hear that, in order to actually get this exceptional growth, you gotta focus. Because can you imagine like if Jay were to like, hey, I'm just gonna buy an 8-unit here in Cincinnati. Hey, let's just buy the next one in Texas for like 10 units. Oh, let's just buy the next one in California for like 20 units. You can see that the experience get diluted versus now Jay has his team in Cincinnati. He has his broker relationship, his lender relationship, everything get rinse and repeat. And that's how that propelled the growth so much.
Yeah.
I also love what you share about going from just buying things on your own to doing multiple JV structure and then testing syndication on a smaller property that you could have easily JV, right? Because at this point, the new thing is the syndication, but same market, you already have the team. And so I really think that's a great way for people to try something new while being able to de-risk it as much as possible
Agreed.
in the process. So that's amazing. I really love that you broke that down for the audience, the thought process behind that as well. So you've been heavily in multifamily. I know when we talk offline, you bought a business and that also has been like a side of it. For the audience who's kind of considering like, hey, should I buy multifamily? Should I invest in business? Give us a quick breakdown of what you liked and don't like between these two and just your experience in these overall.
Absolutely. I would say in terms of pros and cons, right? Multifamily buy and hold real estate investing as opposed to transactional real estate, which is flipping or wholesaling. There's money to be made no matter what type of real estate you do. But multifamily and in general buy and hold real estate is definitely a get rich very slow scheme, right? So over 20, 30 years, you would have amassed enough equity and enough net worth to have a very comfortable life. But initially, when you're starting out, you definitely have to make sure that you have the right mindset to delay that gratification, where you know that check is coming, but it may be 1 to 5 years from now. But at the same time, you got to pay your bills, right? So you need an active source of income. And that was my kind of thought behind starting an active business that produces active income. One that can help pay the bills, but also that income can then be leveraged to, park that capital back in multifamily, right? So that was the thought, but you have to be cognizant that your plans and your thoughts may not necessarily always align with reality because you also have to factor in your return on time. And starting any business while you have something else going on the side, which for me, real estate is truly my primary vehicle and my business and my passion. And complementary was really the business that I started. And if I had bought an existing business, it might have been a little bit different, but I actually started this, so I had to grow it. The growing pains in the first couple of years are very real. If you have to grow a business and scale it relatively quickly, you have to fully focus. 150% of your focus has to be on that business. But my focus was kind of split between the two, which is why I've always struggled in the last 2 or 3 years to just have enough time to be able to just take some time out for myself, my health, my family, and all of that stuff has definitely taken a backseat. So now that I'm rethinking, I'm potentially considering selling my business and fully focus on multifamily. And if I look into some sort of active income again, I'd probably look at transactional real estate, because now you're still in real estate. You're still talking to lenders, brokers, the same people that you're talking to multifamily. On the flip side, if you're doing a completely separate business, you now have different set of networking you have to do, so you have to set time aside for almost two sets of activities based on the two different occupations that you have almost, right? So I think people just need to be cognizant of return on time. And that was my mistake. I was only looking at how much can we make, what's the return on my equity and return on capital, but I kind of ignored return on my time. But there are ways to do it successfully as well. So if you buy an existing business that already has some sort of a management structure in place, then you're not doing everything. But when you're building a business, you are doing everything. And that's where the struggles come from. And the other aspect is how good you are in terms of building systems and processes. So if you're really good at building systems, processes, and teams and training people, then you can actually get there even faster. And it might be more of a limited time while you're burning your candle on both ends, right? And everyone needs to also assess their own skills, their talents. And if there are some areas in which they're lacking, then maybe look into starting a business with a partner or starting the multifamily business with a partner, right? So to make up for your shortfalls, it never hurts. And people hear horror stories about partnerships. Yeah, sure, when they fail, they're nasty. But there are a lot of successful partnerships, and you won't end up in a successful one unless you have tried a few, So
Yeah.
my kind of thought on it.
I love that you share about this thought process on that transactional activity and kind of this passive income activity. And I know we always balance both, right? For a lot of listeners, if you're in a full W-2, that's kind of that time transactional activity, right? The moment you stop working is the moment your income will stop coming in versus something that is a bit more passive like multifamily, where even when you stop working, there's still that money coming in, right? So really think about that in terms of transactional income, passive income, and see what is it that you would dedicate into each of these. And I love what you share about the focus, right? And I think that that's the entrepreneur journey. A lot of figuring out what is it that we're good at, what is it that we should be spending our time, especially now that we're full-time entrepreneur. One thing that I'm always in pursuit of is that question of like, how do I choose where to spend my time and my focus? Love also what you share about partnership. I always say that I think for everyone, when they think about like where they want to invest, there's like that three things that they need to consider, right? Their time, their skill set, and their capital. And most people have one out of these three. And that strategy that you're going to decide how to move forward with will depend on what is it that you have more of out of these three to decide your strategy to move forward. I would love to change to talking a little bit more about passive income. So at this point, you are very established in the Cincinnati market. For the audience who like, hey, we know multifamily is great asset to build wealth in, but we don't have the time, we don't have the skill set. Passive income could be a great fit for them. So talk to the audience more about passive income in a syndication, and maybe how does one decide the opportunity or the operator to invest with?
Absolutely. Fantastic question. Passive income was one of the things that really gravitated me towards real estate as well, whether it's passive income in real estate, investing in private equity, hedge funds, a lot of different vehicles, right? But some of these other vehicles like hedge funds, everyday investors don't have access. Unless you already have millions of dollars, you don't have access to those vehicles. Real estate is a vehicle that's pretty much accessible to anyone and can become a good vehicle for passive income. Now, true passive income is a myth, in my opinion. Someone has to be active, and then you, as a passive investor, even though there is an operator who's actively managing the asset, still have to be a little bit active in terms of just keeping on top of, what's going on with the property, looking at the reports that are being shared. If something catches your attention that, this doesn't look right, you have to ask questions. I've personally lost some money passive investing, so I've learned my lessons there too. But I think when it comes to truly investing passively in a real estate syndication deal, for example, in my opinion, it really all comes down to the operator, right? So which market you're in, whether you're investing in Texas versus Midwest, You can invest in New York City, which in the landlord circles, it's not a place where you invest to make money, right? But you can make a lot of money investing in real estate in New York City or LA or in California as well, as long as you know what you're doing or you're working with an operator who has a strong track record and they know what they're doing, right? So I think by the end of the day, it's not just about how good the operator is in terms of their operations and asset management skills, but by the end of the day, it also really comes down to ethics. And it's hard to figure out how ethical someone is from a few conversations. So I always like to advise people that start small, maybe a 50K or 100K investment, whatever is the minimum investment amount in that deal or with that operator. Start small, observe them during the deal, right? How is the communication? Are they being quick in responses only before they get the money? Or are they responding to your questions quickly even after they have your money? Things change pretty fast. And I've seen people change their colors in no time. And then how did the deal go over time, over 3 years, over 5 years? Was there a successful exit? In changing market conditions, a lot of deals have had challenges. But in those challenging times, you got to observe how is the operator behaving like, right? Are they doing everything they can to protect investor capital? Some of the things I would like to see is the operators are also chipping in their money to save the deal, and they are personally invested in the deals as well. They are signing personal guarantees on the loans. That way, they have actually a lot to lose if the deal goes south. I would like to work with operators personally as a passive investor who focuses on one market and who focuses on one asset, because a lot of really good operators that I like and respect, Ken McElroy is one, Ivan Barrett in Indianapolis is another operator. We have a few local operators here in Cincinnati as well. And they have really done well. Like, for example, Ken McElroy is super focused only on Arizona. That's where he lives. He first built his property management company, so everything revolves around the operations piece. And he continues to buy and grow in that same market for the most part, right? So all of these things matter. And I think just knowing how to invest passively is in itself a learning journey. It in itself takes a lot of education. So just don't go off of the sales talk and the projected returns. You have to look at the risk adjusted returns and understand how the deal is underwritten. Maybe not all aspects of underwriting, but the key aspects that go in, like exit cap rate and rent growth projections, a few levers that can drastically change your returns metrics. Even as a passive investor, I think it's very wise to understand those things, ask those questions before you start investing your money with any operator.
Those are really important points that you brought up, Jay. I really think passive investing could be a great fit for a lot of people, right? They can truly earn passive income. And one thing that I really want to stress is that when you are passive investors in the syndication, you are a part of the ownership. So it's very different from investing in a real estate debt fund where it is a paper commodity. In this case, you are actually a part of this hard asset ownership.
Absolutely.
And so with that, it comes with the tax benefits and everything else, right? But obviously in this case, as you are part of the ownership, it is an equity position. And so Jay, I'm glad that you share upfront about like investing always comes with risk. If anyone tell you there is a guarantee return, that there's no risk, run the other direction, right? So you want to invest with operators that be upfront about the risk, because if they can't see the risk, they cannot hedge it. And Jay, I also love what you share about education. Even though it is passive, meaning you don't have to actively operate the property, you do have to do some education upfront, right? Jay mentioned so many good things about these rent growth, cap rate. These tiny details can easily change the return. So you really want to understand not just the return numbers, but the underwriting, the thesis behind it. So those are all important points. So if you consider passive investing, right, like follow people like Jay, follow people who actually share the education, share the underwriting, share their thesis. And as you follow them, you could understand like, hey, what is your risk tolerance? And what are some of the assets that is a good fit for your goal in building wealth completely passively? Jay, I want to shift gear just a little bit for you to share about your investing pieces and what you are shifting strategy for multifamily in this market. I do think multifamily is a great asset no matter the market, but the strategy has to be adaptable to the market that you're in. So Jay, we'll let you hear your thoughts on how you're adapting your strategy in 2025.
Absolutely. Definitely what was working in 2020, I wouldn't say no longer works today. It still works, but the dynamics have changed and your margins have thinned out. So it's time to reassess your thesis. So actually just a few months ago, we did an investor webinar where we actually spoke to our investors about how we are changing our strategy. So we have never really invested in rougher neighborhoods. I wouldn't say that it's always a bad idea. There are people who specialize in that because they know how to operate in those neighborhoods and how to cash flow in those neighborhoods, right? But we have tried to stick to class A and B, maybe B minus submarkets in and around Cincinnati area. But we did do a lot of heavy value add deals. So starting 2019, my very first deal, up until really 2023, even 2024 early on, we did some deep value add deals. So if you're getting a property in an area that's gentrifying or has already gentrified and is in the right direction, and if we can get a property at a steep discount just because it's in a bad shape, and we can fix it up by putting in $25,000 a door for a full gut renovation. And now, let's say, for example, you buy a property at 50 a door, put in 25 a door, and if it's worth 125 a door, I think it's a good strategy, right? Because you're getting a good return on the money that you're spending on those renovations. Money, time and effort, energy, stress, all of that. But it's worth it by the end of the day. What we are seeing now is because your interest rates have gone up, insurance, taxes, all of these fixed costs have gone up. Your holding time while you're renovating the property, your holding costs have gone up. So if it's taking you a year to renovate the property, it's costing you more because you're still paying for taxes, you're still paying for insurance and all of this stuff, right? Construction costs, once they went up, they didn't really come back down that much. Like even though the materials prices did come down, the contractors didn't lower their prices. So you're still paying a premium on construction. And there are other factors now that bring in more uncertainties like tariffs. And lo and behold, I think the prices will go up because of tariffs. For now, a lot of manufacturers are absorbing that cost. But if the tariffs are here to stay, those costs will be paid by us as consumers. So considering all these factors, what we are seeing now is the return on investment and on your time, energy, and effort on these heavy value add deals is not that high. So we were seeing around 30% ROI on renovations in the past. Now that number has come down to anywhere between 10 and 15% because the price per door has also gone up and your margins are getting squeezed from both directions. So in today's market, for that reason, what we decided that it makes more sense to buy deals long-term because the other aspect of the market that changed is you no longer really have that tailwind from the market that you had up until 2022, where people were in some cases even overpaying for deals, not necessarily always managing them well, but the cap rate was naturally decompressing so fast that they would go in and out in 3 years and hit their 5 and 6 year return projections in third year and do fine, even though they are not the best operators because the market was helping them tremendously. You will be buried if you try to do that today. Even the good operators are struggling in today's market. So today our view is 6 to 10 year hold. So we are buying for long term. We are buying assets in really more like A, B plus neighborhoods, assets that are relatively turnkey. And if they need renovations, they're more cosmetic in nature, where we can get it done within a week or 2 weeks instead of doing a turn, slightly more renovation. And that's where we are seeing a better ROI and a better cash flow, more steady cash flow as well. And it reduces the renovation and construction risk, which collectively all the investors have to share as LPs in the deal as well. So sure, the returns might look slightly lower, but you're not taking on that huge construction risk that you would with a deep value add deal. So that's kind of been our strategy. Now, having said that, if tomorrow a heavy lift deal comes to our table, will we totally just pass on it? Probably not. It all depends by the end of the day, price per door. And if there is enough margin to be made, and if it's in a good location, we would still consider it. But it has to have enough margins where we can safely say that investors will make 7% cash flow. If we are cutting it too thin and that 7 can drop to 3 for investors, we would not take that chance.
I think this is where the theme of risk-adjusted return is so important. If you have 100K or you have 200K, you can easily split this in 2 different deal profiles. Mm-hmm. You can choose it in different markets if you want, but at least you can choose 2 different deal profiles. One is more stabilized cash flow deal that you know will get that cash flow that you need. And the other one more so for the appreciation, right? Mm-hmm. If you were to invest on your own, you can essentially sink all this cash into one property. It may be stabilized and give you a stabilized return, or it may not be, or it may be appreciation. But that's the beauty of passive investing, right? You get to choose how to diversify your risk overall. Why don't have to operate yourself? So I love that you share how that investment thesis changed. And I think it's very important for passive investors and even active investors to think about how they want to spend their time. That return on time, return of money, and that balance of both is very important. I want to switch to the section of the episode where we have a mystery question that was left behind by our previous guest.
Okay.
And your mystery question is, what question do you wish people would ask you more often, and how would you answer it?
A question to come up with a question. Okay.
Yeah.
Interesting. This is more geared towards passive investors. I wish more people asked us questions about the business plan and the thesis and the underwriting assumptions. Now, we like to put it out because we would like to be transparent as to what our assumptions are. Are they in line with some of the data that we see, like CoStar information? By the end of the day, any investment you make is based on projected data. So nobody has a crystal ball and you are taking risks. But at least what are those risks hinging on? And what is the data that you're basing off of your projections on? I wish more people ask that question. And I know not everybody is a data nerd. And sometimes when we have too much data, we kind of lose people during our presentations. But even if that's not something that's clicking right on the presentation, I think if you're putting in 50K, 100K, 200K, no matter what the amount is, of your hard-earned money into a deal with an operator, these are the questions that you should be asking, right? So I think that's the question I feel I wish more investors really ask that question, not just to us, but any operator that they are parking their capital with. In the last couple of years, a lot of people have gotten burned, but I've seen how people have invested their hard-earned money, and I was blown away how they were investing with people who had no experience doing it, and their first deal was a 200-unit deal, no track record. They were taking a huge risk, and a lot of those did not end up well. And, there's a reason for it. So I think doing that, a little bit of extra homework is very much important. So yeah, I think that is the question I feel more people should be asking.
I love it. Not just what's your return, but what are the assumptions? What's your business plan? And get to that. Love it. Awesome. Thank you so much, Jay. I really appreciate your time being on the podcast today and sharing with our audience about multifamily investing, about passive investing. And I would love for you to share how the audience can keep in touch with you and learn more about what you do. I know you mentioned you guys did a webinar earlier this year about your investing thesis and how that strategy might have changed. Would love to share that in a show note as well. But yeah, feel free to share with the audience how they can keep in touch with you and follow your journey.
Yeah, absolutely. I'm pretty active on LinkedIn, on Facebook. So on LinkedIn, my legal name is Jaideep. So that's Jaideep, and last name is Balekar. You can find me on Facebook with the same name. And my email is jayj@prospercapitalco.com. And we have a YouTube channel for Prosper Capital. That's where we host some of these webinars that we do. Some of them are unlisted and private, but if you just send me a message, I can share a link where the investors can go watch some of those videos as well. So yeah, but those are the best places to reach out to me at. And then our website is prospercapitalco.com.
Awesome. We'll put all that in the show note. Thank you so much, Jay. I really appreciate your time today and can't wait to see your investing growth.
Awesome.
Till next time. Bye.
Thank you so much, Yang. Really appreciate it.